Assalamu alaikum friends, welcome to lecture 21 of SBR IAS 37, which is provisions, contingent liabilities and contingent assets. We have three parts to this. Starting with provision, okay, we are going to go through introduction, how do we recognize, how we measure, then derecognition, contingent liabilities, provision and contingencies for specific situations, restructuring and criticisms of IAS 37. So, before we start with provision, you need to know that provision is a liability, right? So that means you have to apply the definition of liability to provision, okay? Most liabilities, the difference between liabilities and provision is most liabilities can be measured accurately, okay? For example, if we take a bank loan, we clearly know it's a liability. Why? Because we have an obligation to pay and we know the amount. But when it comes to provision, the amount involves uncertainty. It has something to do with the future and the amount is uncertain, okay? But still it's a liability. It's still a part of a liability, but it's uncertain, okay? So according to IAS 37, a provision is a liability of uncertain timing or amount. You don't know the time, you don't know the amount, but we definitely know for sure it is something in the future that you have to incur, okay? And it is recorded as a provision. So definition of liability in IAS 37, this was not revised according to your conceptual framework. So if you go back to your conceptual framework in my lecture 1, the definition of liability will not match with this liability in IAS 37 because it did not change. You see? Now, how do you recognize provision? You need to know this. And by the way, in your SBR exam, IAS 37 is the standard which has a very high frequency of occurring. Okay? Most of the time IAS 37 comes in some way or the other. It can come in any question. It can come as a part of group accounting question in question number 1, or it can come in ethics, or it can come in question number 3, or in your conceptual framework question number 4. It can come in any question. But most of the time I have seen IAS 37 comes. Okay, very rarely I think I have seen a paper where IAS 37 has not been asked. So you better prepare for IAS 37 thoroughly. Okay. So IAS 37 requires a provision that should be recognized when and only when two conditions. Number 1, present obligation because of the past event. This is same like liability, right? Now that obligation could be legal or constructive. We'll shortly go through legal and constructive obligation, the difference, okay? But it could be either it's legal by the law or constructive due to past patterns. If you have an obligation, then a provision needs to be recognized, and there is a high probability of an outflow of cash. So in these two conditions, you need to recognize a provision. If these two conditions are not satisfied, you do not recognize provision. It is as simple as that, okay? And a reliable estimate of the amount. So let's start again. First, you need to have an obligation. Number 2, outflow of cash. It needs to result in outflow of cash. Third, amount. You have to make some estimate of that amount. Now, obligation is something that cannot be avoided. Please know the definition of obligation. Obligation is something which you cannot avoid. You have to pay it. Okay. So constructive obligation means due to the past practice, or you might have some practice in some policies in your company, right? That this is how we pay, or we have been paying this in the past, in the history. So that makes it very sure that in the future also this pattern is going to be repeated. That is known as constructive obligation. Okay, because in the past you have been doing something, okay, it raises a valid expectation amongst the parties in the future also. One obligation is that. The other one is legal obligation. Legal obligation means duty or contract or loss. So how do you know you have a constructive or legal? In your exam, the case study that you will be given, they will tell you whether you have some kind of obligation or not, due to past or due to loss. You have to look out for those words, whether you have an obligation or not. Okay, now coming to the measurement. So IAS 37 says provision are measured at the best estimate of the expenditure. The best estimate of provision will be most likely amount payable for a single obligation. Let's say in a court case, they will tell you that you have a 30% of winning this case or 70% of winning this case. So you recognize the provision up to that amount. Okay. Or an expected value for a large population of items such as warranty provision. Okay. We'll do a question shortly. Don't worry. If the effect of the time value of money is material, then provision also should be discounted to present value. Okay. Whether it is material or not, in your examiner will tell you. Whether it is, if it's immaterial, you do not discount provision. If it is material, you need to discount provision, and that discount rate should be pre-tax, that means before tax, and risk specific. They will give you two types of tax: pre-tax, post-tax. You need to pick the pre-tax, not post-tax, for a provision. Okay, this little things you need to be very careful when you're dealing with IAS 37, because IAS 37, even though it looks easy, it is one of the challenging standard in SBR. Okay. Now, subsequent measurement, that was initial measurement. Now it is subsequent later on. If provision has been discounted to present value, then the discount must be unwound and present in finance cost. That means in your statement of profit and loss, you have to recognize that discount as finance cost. It goes as an expense in P&L. So this is how you do it. Debit finance cost in P&L and you credit provision in your statement of financial position. It goes as a long-term liability, your provision. Under your long-term liability, you write provisions. Now, provisions should be remeasured, to reflect the best estimate of the expenditure required to settle the liability at each reporting date. Provision changes every year, mind you. Okay. Now we'll be doing a question, okay, small question before we move on to derecognition of provision. Test your understanding too. This is regarding warranty provision. So you need to calculate the warranty provision required. So in this case study, Clean sells domestic appliances like washing machine, okay, and on 31st December 2001, they decide to sell the washing machine with warranty, okay. So under the terms of the warranty, okay, if the customer does not break it within the warranty period, they will repair the washing machine at no charge, free of cost. So due to the past experience, entity estimates that 20% of washing machine will be sold that will require repair within that warranty period. Okay, at an average cost of clean to 50 per machine, and they sold 200 washing machine. Time value of money should be ignored. So you need to calculate the provision. Before you calculate the provision, tell me whether provision will be recognized or not. That is the first question you need to ask. Should a provision be recognized? If yes, then only it comes to calculation of provision. Otherwise, there itself you have to say provision is not required. So here, a provision is required, yes or no? It is yes. Provision is required. Now I will ask you a question. Why? Why? You need to ask two types of question. If it's a yes, past event. Does the past event creates constructive obligation or the law? Or are there any legal obligation? The word obligation should be there. Due to the history or law. Either one of this has to be there. So it's not due to the law, but due to the past event, there's an obligation. How do you know? Because they told based on the past correspondence, 20%. You see? So they have an obligation. Sorry, this is not a constructive, but this is a legal obligation. I'm sorry, because it has a past event. Okay. So because the past event, the sale has taken place, this creates a legal obligation. That means in the future, you have to repair the machine. So the best estimate would be what? This is based on expected value. Expected value. Because this is a warranty, remember? Like court case where you can give 80% of winning, 20%, it's a single outcome. But here, it's based on expected value. So how do you calculate? It's very simple. You are selling 200 machine, cost per machine is 50 and into what is the percentage of that requires repair during the warranty period? 20%, which will add up to 2000. This is the warranty provision. As simple as that. Now let us move on to the derecognition of provision. So when do you derecognize a provision? Okay, a provision should be used only for the expenditure that relates to the matter for which the provision was originally recognized. Okay, at a reporting date, okay, a provision should be reversed if it is no longer probable that an outflow of economic benefits will be required to settle the obligation. If the conditions reverse, you need to reverse the provision. That means you need to now debit the provision. Earlier you were crediting the provision, now you need to debit the provision to cancel the provision off. That's how you derecognize. Now, so that's it with provision. We are over with provisions. Now we are moving on to contingent liabilities, the second part of this standard. How contingent liabilities are different from provision. Okay, here there's a possible obligation that arises from past event and whose existence will be confirmed. That regarding the obligation is the same as provision. You'll be having some obligation due to past event, that is okay, but whose existence will be confirmed by some future event, and it is something which is beyond the control of the entity, it is outside the control of the entity. Okay, or one condition is that second, a present obligation that also arises from past event, but it does not meet the criteria for recognition as a provision. Why? Either the outflow of economic benefit is not probable, or you cannot make a reliable estimate. It is not possible. In this condition, it is contingent liability that you recognize, not provision. Okay, you don't even recognize, you disclose. You disclose it in as notes in your financial statements. Okay, if these two conditions are there, a contingent liability is disclosed. If the possibility of future outflow is very remote means very far away, you do not even disclose contingent liability. Okay, otherwise a contingent liability is disclosed in these two conditions, not a provision, because in provision you should be able to make a reliable estimate. Okay, and existence will be confirmed. Okay, the outcome of the future event you can somehow predict based on the past event. For example, in the earlier question, we know that we are going to incur the repair cost. Why? Because we have sold a washing machine in the past, and we definitely know for sure it's a machine, it will break down anytime, so you have to incur the repair cost. That's a provision. But contingent liability does not work like that. Okay, but that's why you disclose. You see, you're not taking a chance by recognizing it immediately straight away like provision, but you disclose it. Now let us go to the conceptual framework. What does conceptual framework says? See, conceptual framework says you only recognize an item when it meets the definition of an element. What is element? There are 5 elements. What are they? Asset, liability, income, expense, equity. If it meets any of these 5 definitions, you recognize it, otherwise you don't recognize it. But not all items that meets the definition of an element are recognized. One example is this contingent liability. So if you recognize contingent liability in the financial statements, it will not give a faithful representation. Why? Because the nature of the contingent liability is such, like this. What is the nature? You are not certain whether obligation exists or not. Enough certainty is not there. Or the probability of outflow is very low. Or level of measurement uncertainty is very high. This is the nature of contingent liability. So therefore, you do not recognize contingent liability. You just disclose it under notes. But if the outflow of economic benefit becomes probable, there's a high probability that you have to incur the outflow, then contingent liabilities are reclassified as provision. Then it's no longer a contingent liability if it becomes probable. It moves to provision. Now we are moving on to the third part of this standard, that is contingent asset. Remember IAS 37, provision, contingent liability, and contingent asset. It deals with all these three. It is not just provision. So now we are moving on the third part, that is contingent asset. Contingent asset works in a similar way like contingent liability. The only difference is this is an asset in this case. The rest everything remains the same. So here also it's a possible asset that arises from past event, but existence is confirmed by some uncertain future event outside the control of the entity. A contingent asset should not be recognized. You see, I have bolded out so that it's very clear to you. It should not be recognized. Rather, it should be disclosed. Like how we are disclosing contingent liability. So you disclose contingent asset under the note. Okay. If second point says if the probability or if the future inflow of benefit becomes virtually certain, then you do not recognize it as a contingent asset. Then it moves on to a normal asset. You should recognize it as a normal asset. It could be tangible asset or it could be intangible asset. If it's a tangible asset, under IAS 16 it will be dealt. If it's an intangible, IAS 38. Okay. Or if it's a financial asset, then IFRS 9, depending on the type of asset. If the outflow becomes very certain. Sorry, not outflow, this is an asset. Inflow, I'm sure. Sorry, inflow. Now, this is a summary. This is not the summary of this lecture. This is only summary of IAS 37. We are moving on to some specific conditions, dealing with specific provision after this. So the three things: provision, contingent liability, and contingent asset. These are the three parts we dealt separately. If it's a provision, you should only provide if constructive or legal obligation, if there's a probability of outflow resulting from past event, and it can be measured reliably. Contingent liability, it's a liability. You have to assess the likelihood of the liability. If it's remote, you ignore. If it's possible, that means there's a possibility of liability occurring, disclose. And if it's probable, you disclose or provide. Potential asset. Again, you assess the likelihood of asset. If it's remote, ignore. If it's possible, then also ignore. If it's probable, you disclose. You see, can you see a difference between contingent liability and contingent asset? There's a slight difference. When it comes to recognition or disclosing of contingent asset, the standard is more strict compared to liability. The reason why they are is because they do not want you to overstate asset and understate liability. You see, that's why they say if it's remote or possible in both conditions, you ignore contingent asset. Whereas when it comes to even the possibility, even if it's possible, you still disclose contingent liability. So that they are more strict in contingent asset. The reason why I'm pointing out here this thing is because if you go through other standards, okay, you'll be moving through other standards, right? There also you will face the same thing. When it comes to asset, they are more strict. The standard deals it in a more stricter way than compared to liability. This had happened in your IAS 12 also, income tax, when we were recognizing deferred tax asset and deferred tax liability. This comes in your financial instrument also, financial asset and financial liability. They are more strict on the asset part in all standard, any standard. They are more stricter on the asset part compared to liability. Okay. Now we are moving on to specific situations. Number one, there are around 5 to 6 situations. So we'll be moving on through each situation separately. First, and by the way, in your exam, you'll be given the specific situations if you're given provision. So you need to know which one is out of this 4 or 5, which situation is it. First, future operating loss. For future operating loss, you do not recognize provision. You need to know this. If it's a future operating losses, you do not recognize provision. Why? Because they relate to future. It is not from past event. And you still can avoid this loss-making situation by not doing the business. You can close the loss-making business and not incur the loss. That means you can avoid the loss. See, something you can avoid, you do not recognize provision for it. Because you do not have an obligation to make that losses. So, An expectation of future operating loss. You see, this is a indication of asset. That asset may be impaired. So how do you deal this? How do you deal with this? This is dealt under IAS 36, impairment of assets. Okay, you carry an impairment review and then you deal with according to IAS 36 for future operating losses. Coming to second, Honorious contract. Okay, this type of contracts are those contracts where the cost is more than the benefit. The cost of meeting the contract is more than the benefit of the contract. And these are unavoidable costs. You cannot avoid this cost. To meet the contract, you have to incur this cost. Okay. Now, if an entity has this type of contract, okay, you recognize the provision. A provision should be recognized. And the provision is measured at the lower of these two. Number one, cost of fulfilling the contract or cost of terminating the contract. The lower of this two, you measure the provision for honorious contract. Okay, don't mix this with your normal provision. This is different and normal provision is different. This is for specific situations. This is how you deal with provision. Okay, now we are under the same. Okay, the cost that are required to fulfill this contract will be your incremental cost. Like if you are taking any materials for this contract or any labor for this, they all come under that cost, incremental cost, material cost, direct labor cost. And if you are incurring any other cost, you need to allocate it. Okay, if you are allocating any other necessary cost, that also will come under incremental cost. Like for example, you have taken a property, plant and equipment to fulfill that contract. That property, plant and equipment will incur depreciation, right? So that depreciation charge also will come under incremental cost. Some asset, okay, you need to know some assets may have been bought specifically for use in fulfilling that contract. Otherwise, there is no use of that asset, only for that contract. So in this case, you have to review that for impairment before any separate provision is made for the contract itself. Before you make the provision for that contract, you have to see for the impairment of that asset. Now, moving to the third situation, future repairs to asset. See, some assets, okay, they need to be repaired or replaced every few years. One example is airline. You see, airline by law, they are required to overhaul all its aircraft every 3 years. So how do you deal with it? In this case, provision cannot be recognized. You do not recognize provision for this type of expenses for cost of future repairs or replacement part. Why? There is no current obligation to incur those expenses. Even if the future expenditure, you might ask me why. Because you require it in the future, right? Even if the future expenditure is required by law, remember, entity could avoid it by selling that asset. You could sell the airline and not incur that cost. So you don't have an obligation to incur that cost. If you don't have that airline, you will not incur the cost. You see, you can avoid. Therefore, you do not recognize provision. So you do not recognize provision when it is future operating losses, first situation, and this third situation, future repair to assets. You recognize provision for the second, honorious contract. Now we will be moving on to two questions regarding the specific situations before we move on to the fourth, that is environmental provision. Test your understanding 3, damn boy. So in this question, you are required to discuss the accounting treatment of the above in the financial statement. So what's happening is company is owning several shops. Okay, one of the shop is loss is 50,000, and one of the shop building requires a repair. Okay, the cost was 10,000. The repair is made in the following accounting period at a cost of 12,000. So you see there are two conditions. One is loss making of 50,000. The other one is regarding repair. So how do you deal with this two? That means, in short, the question is asking you whether a provision needs to be recognized or not. So for this 50,000 loss making, I will ask you a question. Do you recognize provision? Should a provision be recognized? No. The answer is no. Provision should not be recognized because provisions are not recognized for future operating losses. This is future operating losses. Please understand. This is the first specific situation. You do not recognize provision for this type of losses. Coming to the repair. Okay, this is something to be done in the future. The repair is made in the financial manner cost of this one. One of the shop building requires a repair to be done in the future. Here also it's a no. No provision is recognized. Why? This is future repairs. This is the third situation. Future, right? This repair has to be done in the future. Third situation also you do not recognize provision. Even though it is probable and capable of being reliably measured, you still do not recognize provision because it falls under the third specific situation, future repair. You do not recognize provision for it because there is no obligation at the year end for this repair. That's why. The repair expenditure of 12,000. Okay, this 12,000. This is expensed in P&L. It goes to P&L as an expense. Okay. Coming to test understanding 4. Smoke filter. Should a provision be, this is very direct compared to third. Should a provision be made at the reporting date for the estimated cost of fitting the filter? Okay, so under this new legislation, entity is required to fit the smoke filter to his factory. At the reporting date, entity has not fitted the smoke filter. Should a provision be recognized? The answer is no. Why? This is future expenditure. This is your third situation. Again, third specific this thing. Future expenditure. You do not recognize provision for future expenditure because there has been no obligating past event. Have you fitted the smoke filter in the past? No. So there is no past event. There is no obligation to fit the smoke filter. So no provision. Now we will be moving on to the fourth specific situation, that is environmental provision. The fourth is environmental provision. Okay, environmental provisions are your cleanup cost. This is usually done after you are deciding to restore an industrial site after the production has ceased, right? Or you are cleaning up after the usage of the asset. So for this, you need to recognize a provision, environmental provision, right? A provision is recognized if past event has created an obligation to repair the environmental damage. Okay, a provision can only be set up to rectify the environmental damage that has already happened. Please understand this. If environmental damage has already happened, you need to rectify, you need to recognize a provision for it. But there is no obligation to restore future environmental damage. Why? Because entity could cease its operation. This is like the future repair to asset or future operating losses. You do not recognize provision for it. But if you have done something in the past for that an environmental damage has occurred and you need to rectify it, then only you need to recognize a provision for it. We'll be doing 2 questions on this. Now, merely causing damage or intending, just you have an intention to clean up a site, does not create an obligation. Okay. An entity may have a constructive obligation to repair the environmental damage. How? Maybe they have their own policies of cleaning up or leading to environmental awareness. Okay. Now, remember, full cost of an environmental provision should be recognized as soon as the obligation arises. And in this case, most of the time, effect of the time value of money is material. Therefore, you discount. You discount the environmental provision to present value most of the time. In fact, I think I have all the time. That's why you'll be given a discount value also to discount. It's expenditure. Okay. If the expenditure results in the future economic benefit, sometimes it happens due to the expenditure, you might be incurring some asset. So you need to recognize that asset. And you need to depreciate that asset also over the useful life. And this useful life is the same as the life of the provision. Now we'll be doing two questions in environmental provision before we move on to restructuring. Test your understanding 5, environmental provision. So you have been given two situations and you need to explain whether a provision should be recognized or not. Situation A. In situation A, an entity has a policy of only carrying out work to rectify damage caused to the environment when it is required to do so by local law. Okay. For several years, entity has been operating an overseas oil rig which causes environmental damage. The country in which oil rig is located has not had legislation in place that require this damage to be rectified. A new government has recently been elected in the country. At the reporting date, it is virtually certain that legislation will be enacted that will require damage rectification. This legislation will have retrospective effect. Okay, so first we'll deal with situation A and then we'll go through situation B. Okay, now whenever a question like this is asked, you need to ask two questions. Okay, two questions need to be asked. First one is the present obligation a result of the past event? Second question, is an outflow of economic benefits probable as a result? If the answer to both of them is yes, okay, then you recognize a provision, otherwise you don't. Okay, I'll write down the two questions out for you. So the first question is, okay, question 1, is there a present obligation is there a present obligation as a result of a past event? Second question, is an outflow of economic benefit probable as a result? This is for environmental provision. Okay, so if the answer to both of this question is yes, you recognize a provision. So you need to see for the first one. Okay, we'll go by the first one. Is there a present obligation to rectify the damage? The answer is yes. Second question, what about the outflow of economic benefits? Is there an outflow of economic benefit? Yes, there is. Okay, so the conclusion is you recognize a provision for the first one. Now, why do you have a present obligation? I'm going through the first one. Okay, why? You need to explain the reasons why. Because the new legislation will have a retrospective effect. Retrospective effect means backward. You are going in the past and you need to change the figure. Okay, and it is virtually certain to be enacted. You see the word virtually certain, I've underlined it also, right? So the damage caused by the oil rig is the past event that gives the rise to a present obligation. You see, for several years the entity has been operating an overseas oil rig. This has been done in the past. Because of this, now you're going to have a damage. That means you have a present obligation. So yes, you recognize a provision. Coming to B, this is about a license. Under a license granted by local government, an entity has constructed a rock crushing plant to process material mined from the surrounding area. Mining activities have already started. Under the terms of license, entity must remove the rock crushing plant when mining activities has been completed and must landscape the mined area so as to create a national park. Again, the same two questions you need to ask. First one, do they have a present obligation? The answer to this is yes, it does. Is the outflow of economic benefit probable? Definitely yes. Why do we have a present obligation? Because of license, you have a legal obligation. You see, you have a license to remove the rock crushing plant. You have a legal obligation under the license. Understanding? So you need to recognize a provision for this as well. Now we are moving on to test understanding 6. Okay. Explain how the above should be treated in financial statement. So on 1st of January 2006, you need to be a little critical in this one because it has to deal with 3 years. You need to deal with financial statements. Whenever they ask financial statement, it is about your P&L, it is about your statement of financial position. Okay. Especially these two things will be there. Okay. So 1st of January 2006, Scrubber spent 5 million on erecting infrastructure and machinery near an area of natural beauty. These assets will be used over the next 3 years. Scrubber is well known for its environmentally friendly behavior and is therefore expected to restore the site after its use. Estimated cost of removing this asset and cleaning up the area on 1st of January 2009 is 3 million. Pre-tax risk specific discount rate is 10%. Already they have given you. No need to adjust it for tax. No need to adjust it for risk. Already they have given you. Your work is easier. Just use the discount rate and discount it. Scrubber as a reporting date on 31st December. Okay. So you first need to understand whether a provision needs to be recognized or not. For that, you need to understand whether obligation is there or not. Right? It has an obligation. It has a constructive obligation. Constructive obligation is there to restore. Right? To restore the area. How? As a result of the past event, because you have erected the infrastructure. That's a past event. Right? And Scrubber is well known for its environmentally friendly behavior. You know, they are well known. It has been done, something that has been done in the past also. So constructive obligation is there. Therefore, you have to recognize a provision. Okay. And what would be how much would be the provision on 1st of January 2006? You have been given it as 3 million. You need to discount this. Right? You need to discount this. So on 1st of Jan 2006, right? 3 million, you are discounting it by 10%. Okay. That means 1 divided by 10. Sorry. 1 plus. Sorry. 1 divided by 1 to the power 1. If you do that, 1 divided by 1.1. Wait. Sorry, this is to the power 3. It has to be. I'm sorry. I will. Wait. Do it again. You need to multiply this. It will be 1 divided by 1.1 because 10% to the power 3 because for 3 years. Okay. Calculate it and tell me the answer. It will be 0.751. This answer will be 0.751. That means 3 million into 0.751 because for the 3 years it will be 2253,000. This will be the cost, present value. Okay. Now you need to be careful here. See, Scrubber cannot carry out this operation without incurring the cleanup cost, right? You need to clean up. Once you do up the cleanup, then only you can carry out the operation, right? This means that incurring the cost give access to future economic benefit. That means an asset. It is giving a rise to an asset. So this estimated cleanup cost will be added to your asset, property, plant and equipment. Okay, so you debit PPE or your asset and you credit your provision. This cleanup cost will be added up to your asset, cost of the asset. Because without, see why it will add up to the cost of the asset, why this will be capitalized, why not expense? Because without this cleanup costs, you cannot carry out the operation. That means it's important for your asset to function to incur this cost. That's why. And this rule is according to IAS 16. Go to IAS 16 and check out the rules. What are the costs that you can capitalize as an asset? So here it will be 2,253,000. 2,253,000. Okay. Each year, that means each of the 3 years, 2006, 2007, 2008. Sorry, 2006, 2007 and 2008. Because 1st of Jan 2009, that means it will end up on 31st December 2008. For the 3 years, right? The discount unwinds and provision increases. And that unwinding of the discount is charged to P&L as a finance cost. You need to remember this always whenever provision is there and when you are finding the present value. The interest goes to P&L. Okay. Now we are going to do a table. You need to do this table, okay? Movement on provision, because this is for more than 1 year. Whenever it's more than 1 year, do this movement on provision table. Okay. 2006, 2007, you can do it in your Excel. 2008. Okay, in 1st of Jan 2009, this will be the balance. This is 1st of Jan. All these are 31st December. 31st December. 31st December. Okay, opening balance. Opening balance just now we have got 2,253. Okay, this will be in thousands. We'll drop down the 3 zeros and we'll deal it in thousands. The work becomes easier. Rather than dealing in millions, I will deal in thousands now. Okay, 2,253. I'm getting this figure from here. I have found out after discounting the 3 million, right? So this is for 2006 opening balance. After that, you take 10% on it because 10% was the discount rate. 10% of this 2,253 because you have to unwound the discount. Remember, unwound. This is the meaning of unwound discount. 10% on that amount on the opening balance. 225. 10% of 2,253. Okay. Then closing balance. The discount is added. Okay. So once we add the discount to it, the closing balance will be 2,478. It will go up. This becomes the opening balance of the next year. 2,478. 10% of that will be 249. 2,727. Now this 2,727 will be the opening balance of next year. 10% will be 273. If you add, it will be 3,000. You see at the end you have to get 3,000. It's in the future, that's what we have discounted. So here it will be 3,000. You don't have to discount, nothing goes. Utilization. The whole 3 amount will go. Because at the end, there will be no provision, right? You only recognize provision till after the 3rd year, there is no provision. This 3,000 will go, you will be left with 0. Your provision will cancel off. This is how it always works. Okay, what will be the initial cost of PP? So this is the movement on provision table. Next, initial cost of PPE. Okay, 1st of Jan 2006, whatever the cash that you have paid. You see here, it was 5 million. Because they told scrubber spent 5 million on erecting infrastructure and machinery on 1st of Jan. 5 million. This is the cost. We'll drop down the 3 zeros. It's 5,000. You add the present value of cleanup cost, which is 2253. This would we have found in the beginning. This cost. Remember, I told you add this up with the initial cost, and the total will be 7253. This will be the cost. Now you have to show the impact on the statement of financial position and statement of profit and loss, because without all these steps you will not be able to do it. So I've been waiting to finish all this before I jump to the financial statement, rather than straightly jump into the financial statement. Why? Because even if you jump to the financial statements, what are you going to write there? You need the cost of PPE. You need the provision, the movement in the provision. Now, statement of profit or loss. So here, 2006, 2007, 2008, 2009. Because they have showed till 2009, right? So the cost. Depreciation. You have to recognize the depreciation. What is the asset? It is 7253. So this 7253 will be now divided by 3 for depreciation. It will be 2418. Even though it will not be exactly 2418 all the 3 years, in 1 year you can reduce one figure. Okay, 2418, 2418, 2417, because all the 3 year depreciation, if you add, it has to add up to 7253. Okay, now finance cost. You have a finance cost as well, the interest. This you have already done in the table here. Moment, this 3, 225, 249, 273. You put it here. Now you understand the reason why you have done the finance cost and the depreciation. For this reason. That's it. Statement of financial position. Here only the here PPE will go. Cost 2006, 2007, 2008, 2009. Same 7253. It will be 7253. It will be 7253. Here the depreciation will be 2418. You add this years with this second year, it becomes double. 4836. This year's depreciation you add up with the third year. Accumulated depreciation, right? Depreciations are accumulating. So carrying value. Four, 835, 2417, nil. What about the liabilities? The provision. Provision goes under liabilities. Okay. Provisions will be here, the moment in the provision. You have to check. This. The closing balance of the provision you have to take. This is why we do the table. 2478 in 2006, 2007 is 2727, and finally 3000. It has to be 3000. You see, the easiest way is to see. Here they have given you 3 million on 1st of Jan 2009. That means 31st December 2008. So you have to end up with that balance. Right? That's it. Now we'll be moving on to restructuring. Now we have moved on to restructuring. Okay, restructuring is a program that is planned and controlled by management and has a material effect on two things. One is the scope of the business. That means what products or services you could provide. The other one is the way the business is undertaken. This is the meaning of restructuring. Okay. IAS 37 says restructuring includes one of those two things. Either closure or sale of a line of a business, or closure of a business location in a country, or relocation of business activity from one country to another. If any of this is there, the meaning is it is restructuring. You have to deal it according to IAS 37. Okay. If it is selling of an asset or of any other things other than a business, then it is not restructuring, and you need to deal it according to the other standard that is applicable for that. If it is a sale of a business or relocation of a business or closure of a business in a country, then only it's a restructuring. Otherwise, it is not restructuring. Okay. Now, where can a provision be recognized when it's a restructuring? You need to be very, very careful. For restructuring, okay, earlier it was legal or constructive obligation. Then you recognize a provision. But for restructuring, you recognize it when there's a constructive obligation to carry out the restructuring. Meaning, there should be evidence that a restructuring is going to take place. Okay. Just having a board decision that you are going to restructure is not enough to say that this is a restructuring or you have a constructive obligation. Constructive obligation exists only if these conditions are there. Two conditions need to be satisfied. One, you need to have a detailed formal plan that restructuring is going to take place. For example, in that plan, you need to know what is the business, where is the location, which are the employees that are going to get affected, the timing as well as the cost. And employees that are affected needs to be informed of this plan. Okay, that means you need to announce. Constructive obligation, remember, constructive obligation must exist at the reporting date. If it exists after the reporting period, okay, it is a non-adjusting event and it is dealt under IAS 10. Okay, you just disclose it. Okay, you need to be very careful. When is this constructive obligation? Which period? Is it during the reporting date? Okay, then it's a restructuring. If it is after the reporting period, then it is under IAS 10 you need to deal with events after reporting period, and it's a non-adjusting event. You do not adjust it, you just disclose it. Measuring a restructuring provision. Okay, you can only recognize those costs that are directly due to restructuring. If you're incurring any cost only because of restructuring, then only you recognize the provision only for that amount. This must be two things, both necessarily entailed by the restructuring, that means because of restructuring only you are incurring that cost, and it should not be those costs that are anywhere dealt, like that are ongoing activities of the entity. Like whether restructuring is there or not, you are anyway incurring this cost. Those costs are not taken as restructuring. They are not part of restructuring. Therefore, you do not recognize a restructuring provision for the ongoing activity. You need to be careful. Now, IAS 37 prohibits the following costs to be taken as a restructuring provision. These are the four costs. Number one, retraining and relocating staff, marketing product, expenditure on new system, future operating losses unless it arises from honorious contract, profits on disposal of asset. These five costs are not taken as restructuring provision. Okay, need to be very careful. If it is out of this one of these five, they are not restructuring provision. You cannot take them as a restructuring provision. Why? Marketing. Okay, let's go one by one. Retraining and relocating staff. Agreed, it could be due to provision, but sorry, restructuring. But even if restructuring is not there, don't you retrain your staff? If new things come up in the market, don't you relocate your staff? You do. So this are anyway ongoing cost. You will anyway incur it. Marketing product, you anyway market the product. They are general cost, not only for restructuring. Expenditure on new system, you anyway incur them. Future operating losses. Earlier we told future operating losses, no provisions are recognized. But if it is from honorious contract, you recognize provision. Profits on disposal of assets. They are not part of restructuring. You do not dispose assets because of restructuring. It should be a business, selling of business. So this five costs are prohibited to be included in restructuring provision. Now, the amount that you take Okay, it should take into account the expected future event also. That means any expenses that you're taking as restructuring provision are the actual cost. Okay, once you know the cost, you take them as a provision, even if it was discovered after the reporting period. I mean the amount, the actual cost, even if it was discovered after the reporting period. Okay, you take it. This is an adjusting event after the reporting period. Don't get confused this with the earlier slide. Earlier slide I mentioned it as non-adjusting event. What? The recognition of restructuring provision. That means the constructive obligation. Constructive obligation has to be in the reporting period. But the cost of restructuring could be discovered after the reporting period also. Still you have to recognize it in the current period. Right? You have to adjust your figure once the cost is known. Even if that cost is known after the reporting date. Okay, it will be dealt according to IAS 10 as adjusting event. Now do you get the difference? So do not confuse this with that. Okay. Earlier slide I was talking about non-adjusting event. That is constructive obligation. That should be during the reporting period. This one is about the cost. Okay. So now we'll be doing 2 questions on restructuring before we move on to the last part of this lecture, that is some criticisms of IAS 37. Test your understanding 7. Here you are given 2 schemes and you need to decide whether provision will be recognized and the amount. So be very careful with the dates. Okay, when it comes to restructuring provision specifically, dates are very important. On 15th Jan 2005, Board of Directors voted to proceed with 2 reorganization schemes, involving the closure of 2 factories. Reporting date is 31st March, and financial statements will be authorized for issue on 30th June. Scheme 1. Closure announced cost will be amount to 125,000. Closure will be announced in June. Announced in June and will commence in August. So for the scheme 1, tell me whether provision will be recognized or not. And if it is recognized, what is the amount? Here, there will be no provision that will be recognized. Why? Because check the obligating event. Obligating event means the announcement of the plan. That is the obligating event, right? When is the announcement of the plan done? It occurs after the reporting period. That is after 31st March. Therefore, this will be a non-adjusting event and it will be dealt according to IAS 10. It will be disclosed as a note. Okay, they should be disclosed as a non-adjusting even after the reporting date. Because the announcement has been done in June and your reporting period ends at 31st March. So the obligating event itself is not in before the reporting period. Coming to scheme 2. Therefore, no provision is recognized. Scheme 2. The cost will amount to 45,000 after crediting 105 profit on disposal of certain machine. That means after they have net off the cost with the profit and got this cost. Okay. The closure will take place in July, but redundancy negotiations begins with the staff in March. Scheme 2 is little different. Okay. Before jumping whether provision will be recognized or not, look at the facts. Look at the obligating event. Okay. Here the obligating event is not about the announcement. Here it is about the whether employees will have a valid expectation that redundancies will go on or not. They will. Why? Because it started in March, before 31st March. They were made aware of it. Staff knows it. Redundancy negotiations have taken place from March, which is during the reporting period. Even though the closure is in July, does not matter when the closure is. What matters is whether employees are known about it or not, whether the plan has been announced or not before the reporting period. Okay. So in this condition, yes, you have to recognize a provision. Okay. How much? Provision will be 105 plus 45, 150,000. This is the amount of provision. Why? You cannot net off your profit with the cost. Right? Profit on disposal cannot be netted off against the expected cost. This 45,000 you have got after crediting, after netting off. That's why you are adding it back. Right? The cost must have been 150,000. But what did you do? You deducted 105,000 from it, and then you got the net cost as 45,000. It's not allowed. You cannot net off like that, because they told after crediting you are getting 45,000. If it was before, then no need. Then it would be 45,000. Be very careful. Each word plays an important role. After, before, right? That's why. So the cost is 150,000, the provision. Coming to test your understanding 8. You have been given some cost regarding the closure. Now you need to understand. So you need to identify out of this amount, which amount goes for restructuring provision. Okay. Before that, let us read the first para. On 30th June 2002, director decided to close down a division. This division was announced to the employees, effective on 15th July. Okay. And actual closure occurred on 31st August 2002. Okay. Prior to 2002's financial statements authorized for issue on 15th September. You have been given some expenses. Okay. You have been given redundancy cost that is estimated. Staff retraining actual. Operating losses estimated at 30th June. Profit on sale of property. Actual redundancy cost was 20 million. You see here redundancy cost estimated is 22, but actual was 20. And actual operating loss for 2 months was 15. Here estimated was given as 12. Now on 31st July 2002, how do you recognize? This is a very simple question. You just need to know out of this cost that is given to you, which one you take in restructuring provision and which one you do not take. Okay. So out of all this cost, only one cost goes as a restructuring provision. Tell me that. If you're wise enough, you'll be able to figure it out. It is redundancy cost. Only redundancy cost goes as a restructuring provision. Because according to the list, all the costs are prohibited. You see, staff retraining. Can you take it as a restructuring provision? Nope, it's a prohibited. Remember that list in the previous slide. Operating loss, future operating losses, you do not recognize a provision. Profit on sale of a property, that means profit from a sale of an asset. These are prohibited cost. So only cost goes as redundancy cost. Again the question comes, redundancy cost, estimated or actual? Actual. When actual is given, you take actual. When actual is not given, then only you take estimated. It doesn't matter at which date actual is known. Since actual is given, actual redundancy cost only you have to take as a restructuring provision, which is 20 million. So only this 20 million is the restructuring provision. Other all are prohibited. Right? 20 million. Now we'll be moving on to the criticisms of IAS 37. The first criticism of IAS 37 is judgment. IAS 37 means judgments are required. Why? Because provisions are estimated liabilities. Okay. So because you are using a judgment here, it increases the risk of bias. Therefore, there is an issue with comparability between entities. Second, inconsistent. Before you recognize a provision, an entity must assess if the outflow of economic benefit is probable or not. Okay, and when you check this consistency, it is inconsistent with other standards like IFRS 9. Right? Recognition of provision is inconsistent with other standards, like the recognition of a liability. Outdated. IAS 37 is outdated. Right? It does not reflect the current thinking of IASB, that is International Accounting Standard Board. This was issued many years ago. It still needs to be updated. Best estimates. The fourth criticism. Okay. They say that provision for single obligation, like a court case, okay, they are recognized as the best estimate. But guidance of what is best estimate is still lacking. Okay. Type of cost. IAS 37 does not specify what type of cost should be included when measuring a provision, because some includes legal cost within the provision and others do not. So it's very unclear what cost to take and what not to take. Then there are a few more criticism. Risk. Okay. You have to make a risk adjustments to provision. But the IAS 37 does not explain when to do this or how to calculate that adjustment, like when to do the risk assessment and how to calculate that, or how to include it in the recognition of the provision. Contingent asset. Okay. These are not recognized unless the inflow of benefit is virtually certain, right? But what is virtually certain? How can you say something is virtually certain? The meaning is not very clear cut. Timing. There's a timing difference between when one entity recognizes a contingent liability and the other recognizes a contingent asset. There's a difference. Then the last criticism is contradictory guidance. What does it mean? IAS 37 defines an obligating event as one where the entity has no realistic alternative but to settle the obligation. That means they say that you have to settle the obligation, which is not very realistic because in reality, one might not settle the obligation. However, the standard also states that no provision should be recognized if the liability can be avoided by future actions, right? But those future actions, even though they are unrealistic, right? For example, you might say that you do not recognize provision for future operating losses by saying that don't run the business, just close down the business. But do you think it's very realistic, this type of actions? No. One example is changing the nature of the entity's operation. Do you think it's very realistic, even though we say we can avoid it? No, right? But IAS 37 still goes by it. That because you can avoid something, you do not recognize a provision, which is unrealistic. So that's it for IAS 37. Now let us summarize everything that we have discussed in this lecture. Starting with provision. Okay, we have defined what is provision, then we went through recognition and measurement. Then we went with contingencies, contingent liabilities and assets. Okay, when it is in assets, it is more strict, okay, compared to liabilities. Then we went through restructuring. We defined with then with recognition and acquiring a provision. Then we went through the 4 specific situations, starting with future operating losses. We do not recognize a provision. Honorious contracts, yes, we recognize a provision. Future asset repairs, no, we do not. Environmental provision, yes, we recognize a provision. Then events after the reporting period, adjusting and non-adjusting. You need to remember. So in short, this is just a snapshot of what we have discussed in this lecture. Now it's your time to go and do the questions from the revision kit from your past paper on IAS 37. Thank you for watching and see you in the next lecture. The next standard will be IAS 38, intangible asset. And if you are watching this video for the first time, don't forget to subscribe to my channel. There's a whole playlist on my channel where you can get all my SBR lectures from my lecture 1 until now. See you and take care.